My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in revenue and are found at some of the largest proprietary trading firms and hedge funds in the United States. Accelerate your wealth with the WAM Dividend Accelerator. Every investing and trading strategy has risk. The WAM Dividend Accelerator has another potential risk that must be seriously considered before engaging in this strategy, and that is you must work with a tax professional that understands your specific tax circumstances to understand if this strategy is right for you and how you should manage it. What is the WAM Dividend Accelerator strategy? The WAM Dividend Accelerator strategy is a strategy that invests in dividend-paying stocks with hedgeable options. It identifies stocks that pay a combined return of 25% or greater per year in dividends and collected option premiums. 9 reasons to invest in the WAM Dividend Accelerator strategy. 1, you can invest in a strategy that can produce 20% a year or greater returns for years after the investment. Some of these investments you could literally hold 20, 30 years, even a lifetime, even pass on to your kids. 2, you invest in a strategy that makes money in 5 out of 6 market environments, including making 20% a year or greater in years in which the stock makes nothing. So what are the 6 market environments? Up fast, up slow, sideways choppy, sideways quiet, down slow, down fast. Those are the 6 environments. The WAM Dividend Accelerator can make money in 5 of the 6 environments. The only environment it will lose in is down fast. That's right, you heard me. It can actually make money down slow. It can make money when the stock actually goes down, provided it doesn't go down too far. But 5 of the 6 environments, it makes money. 3, you could invest in a tax advantage strategy. Now, this is dependent on your situation. It's dependent on your structure. It's dependent on your country. So you have to check this out for yourself. But invested in the right way, in the right situation, these are stocks that you'll hold longer than a year. So they are treated as long-term capital gains. And if you do it right, you might hold the stock forever and never sell it. So therefore, never pay any taxes on the stock. So, but again, it depends on the structure you create and your status. Number 4, you're investing in liquid investments. I cannot emphasize this point enough. These investments that you invest in, many of these you can be out in 1 to 3 days tops. In a lot of cases, you could be out in a few minutes. Compare this with other cash flow strategies. Most cash flow strategies are illiquid. They're great, but they are liquid. You can't get out of them tomorrow. You own a business that pays you. Well, you can't sell that tomorrow. You own real estate that pays you rents. You can't do that. You can't get out of that tomorrow. You own something like property tax notes or things of this nature. You can't sell those tomorrow. Bonds are something you could sell tomorrow if they're treasuries, but even some corporate bonds are hard to sell. Not this strategy. This strategy is liquid, where you can get the money if you need to. 5, if you set up the account in a margin account, and specifically in a portfolio margin account, you don't even have to put up very much money to fund the strategy. So the returns, when you make 20% or greater in a year, they could be substantially bigger if you look at return on margin. 6, you can borrow against the stocks if you need capital. These stocks are liquid. Banks are happy. Clearing firms are happy to loan you money against them. You could also, if you have it in a margin account, you could actually take a withdrawal and just make sure you have enough money to fund the margin. 7. Ooh, 7's a good one, but you're going to have to wait. Yeah. Okay, 8. You gain cash flow without dealing with all the pains in the ass of a lot of other structures. The pains in the ass of real estate, having to buy it and clear title and have title insurance and deal with tenants that are a pain in the ass and damage. Owning businesses, having to deal with employees and regulations and regulatory agencies. This strategy is hassle-free. And finally, number 9, the time. For a strategy to qualify for infinite wealth, you have to be able to do it in 10 hours a month or less, or 2 hours a week or less. Well, the WAM Dividend Accelerator can be done in 1 to 2 hours a week tops. So you can totally do this while you have a job. You can totally do this while you're retired, just having a great time. You can do this while you're chasing your passions and living in your mission. Doesn't take long. All right. So I want to share with you a story about how it all started. Now, in my early days as a trader, I was heavily influenced by my dad and traders I was around that love trading commodities. So the 80s was the great boom. The 70s and 80s were the great heyday of commodities. And commodities made many, many traders millionaires. So I was around a lot of these people that made or lost lots of money in commodities. Many of them became millionaires in commodities. And so I was drawn to that. Just think of the movie Trading Places. It's one of my all-time favorite movies. It's about commodities. That was when I was in high school. Okay, so I was, just because of my circumstance, I was kind of a perma bear. The crash happened in 1987, and that was a big deal to me. I was 18 years old during the crash in 87, and I was on the exchange floor at the Chicago Board of Trade, and I saw the chaos. I saw the fear. I saw wonderment. Like, was the market even going to open tomorrow? Was the world coming to an end? I didn't know. I was only 18, but I was in the midst of it. I never forgot that. 1987 seemed like 1929. So then as the stock market started to rally out, I knew people that made millions being short in 87. I had an attitude of being kind of a perma bear. I was always kind of bearish. I learned a lot from that because that was a massive mistake. I missed out on one of the great decades of stock growth because I was attached to being a perma bear, right? So for years, I watched the market go up and I wasn't invested. But all that started to really change in 2008. Now, one of the reasons I was always a perma bear was I looked at this chart right here. And this chart basically shows the differential between the dividend yield on the S&P 500 versus the 2-year bond. And what you can see is all through the 90s, the dividend yield was really low and the 2-year yield was really high. So it had a big negative differential. So quite simply, like, why would I invest in a stock that pays 1% dividends or 2% dividends if I could invest in a 2-year bond that paid me 6, 7, 8% risk-free, right? So the stocks need to make at least that and then some to account for the risk. So oftentimes I just didn't see the logic. But when we got into 2008, we got into 2009, look what happened. It was the first time in my career that this ratio flipped the other way, where stocks were paying significantly more in dividends than bonds were paying, treasuries were paying. So that got me thinking that stocks were actually cheap. Okay, so what did I do? In 08 and 09, I decided, I went out and I started doing scans and I started looking at dividend paying stocks. And I was able to come up with a list of 10 stocks, all with dividend yields greater than 10% per year, that were trading at 33% discounts to their net current asset value. And they all had annual option premiums as defined by the 30-day, 30 delta call of greater than 25%. So I started looking at these and I'm like, these are cheap. So we actually bought, I went to my partners and we put up $6 million between the three of us to do 3 separate investments. We bought this basket. We put $2 million in this basket of 10 dividend paying stocks. We put $2 million into closed-end corporate bond fund, closed-end muni funds. And we put $2 million into closed-end corporate bond funds. And all of them the muni funds were yielding munis were yielding over 15% a year, essentially tax advantaged. And the corporate bond funds were all yielding over 25% a year. Some of them were yielding 40, 45% a year in corporate bonds. That's how crazy everything was. So I went to my partners. We put together $6 million and off we went. We bought $6 million, including $2 million of these stocks. Now, the crazy thing was that right after we did that, the first week, we were down well over $1 million. At one point, we had a $1.7 million drawdown on the $6 million that we invested. And my partners came to me and they're like, are we okay? Like, are we good? And I was always known for having great planning. I was a great strategist and planner in trading. So they're like, what's the plan? What are we doing? And I was like, I don't know. I didn't know. I knew these things were cheap. I could see the valuations, but I did not do a good enough job of creating my plan. So I'm like, I need to step away and I need to think about this. I need to get really clear about what I'm doing, because this is a good example where you can buy something cheap and it just gets cheaper, and you could get killed buying something cheap, watching it get cheaper. All right. So what I did is I stepped back and I thought about, okay, why did we do this in the first place? All of these things we invested in, all these things we put money in, we did it for the yield. So if the price went up, that would be great. But I'm looking at it going, okay, I'm making 35% or more in each of these stocks. I'm making 15% or more in munis, and I'm making 25% or more in corporates. These are all about yield. So I thought about this and I'm like, okay, I need to think of this differently. I can't think about the price. I just have to look at the yield. So I want to share with you an analogy. So imagine you buy an apartment building for $1 million, and this apartment building nets $200,000 per year after expenses. expenses. So you're getting a 20% return. At this rate of return, it'll take you 3.6 years to get your money back. When you buy this apartment building, are you out ordering an appraisal every week? No, you're not. One, because it's expensive and time consuming to get an appraisal. But two, you didn't invest in the apartment building for it to go up in value. You invested in it for the 20% return. So if the property goes down 50%, you don't really care. Of course, you don't want the whole thing to disappear, but you don't really care because you're getting 20% a year on your capital. You might not like it, but you don't really care. You're getting a 20%. Now, I want you to compare this where if I bought a spec home for $1 million, that has no return. It has no yield, right? In fact, it probably has a burn rate. I'm paying interest potentially to the bank, or I'm paying property taxes and insurance to keep it up. So when I do a spec home, the only way I make money is to sell it for more than $1 million. And I'm motivated to do that as quickly as I can. But in the apartment building, I have $200,000 a year coming in every year. When you go look at some of the really wealthiest people, they own lots of real estate that just cash flows. And they don't really care about the value of the building until their depreciation expires. They just hold it for a long, long time. So what I want you to see is when I thought about this, and I'm like, I'm invested in this for yield, not for price. I don't really care if the price goes down. I'm still getting my 35%, my 15%, my 25%. I don't care. That created a powerful frame for me. And that gave me clarity on what was an investment and what was a trade. An investment is something you put money into for yield. A trade is something that you only make money through appreciation and selling higher. So this is a radically different view. Most people look at investments as something they hold for a long time. That's not the case here. An investment is something that pays you yield. So if you own Amazon and you've owned Amazon for 10 years, you have a trade on. I don't care what you say. Amazon doesn't pay you anything. The only way you're going to make money is to sell Amazon for more than what you bought it. You have a trade, not an investment. Once you get clear about this, this is a powerful frame for how to think about everything, every opportunity that comes your way, everything that you have in your portfolio. Now, one of the things that we're always doing with our students is we want them to become infinitely wealthy. And infinitely wealthy is when our passive income is greater than our monthly expenses. When this is the case, we never have to work. When this is the case, we work on things that we want to. When this is the case, we set our schedule the way that ever we want. We have ultimate freedom. Now, I talk about there's being rich and there's being wealthy. Rich is having a lot of cash. You could have 10 million in cash and you're rich, but you're not wealthy. Why? Because if you don't invest that 10 million every month, you're becoming poorer. Right? So you have 50,000 a month in living expenses. Well, month one, you have 10 million. Month two, you have 9,950,000. Month three, you have 9,900,000. You're getting poorer. So you have cash you can deploy, but you're getting poorer. Now, when you're wealthy, you have cash flow constantly coming in. And the great thing is, so when I look at person A with 10 million, I may have person B, and person B might only have 4 million, but they're invested in cash flow assets that pay them $1 million a year in cash flow. Let's just say 1.2 million to keep it easy. Well, every month they have 100,000 coming in, 100,000 coming in, 100,000 coming in. So if they spend 50,000 a month, well, they had 100 coming in, they spend 50, they still have $50,000 more going into savings. So at the end of month one, they're now at 4,050,000. Million two, they're at 4.1 million. Month three, they're up 4.15 million. They're getting wealthier. They can't even spend it all. This is wealth. Okay, so what I want to share with you is there's a powerful frame here. It's really important to understand. We want to do things that give us large hits of cash, appreciation, and that cash builds a war chest of capital, just like the 10 million. You make 10 million, you've got a war chest of capital. Then what you do is you become opportunistic as to when you buy cash flow. So one of the things I always say is cash flow is not a consistent endeavor. It is an opportunistic endeavor. You can't just buy cash flow whenever you want. You need to wait. People get into trouble because they buy bad cash flow, expensive cash flow. They're investing to get 4%, 5%, and then something happens in the market and it's a loss and they don't have the cushion to ride it out. So opportunistic means that we just wait for certain conditions. And in those certain conditions, we deploy our capital. And when we do this, then we set ourselves up to be wealthy. When we do this, we set ourselves up to be in long-term investments that cash flow for years and years to come. Well, in the WAM Dividend Accelerator, that's what I did back in 2009. I deployed the capital because everything was super cheap. And then that created a basket of cash flow that could pay me for years years. Now, full disclosure, it was in my trading firm. And when I sold out of my trading firm in 2013, I had to leave all that behind. It's kind of a bummer because, just for example, one of the stocks I invested in that portfolio was a stock called Ashland. And you can see I invested in Ashland on January 30th, 2009 at roughly $4. I think it was 408 to be exact. Okay, so look here on the right. This is just done on January 2nd. We bought it cheaper. But if we bought it at $5.39 and you bought 100 shares, that stock in 2001, in September of 2001, is $86.35. And right now it's much higher. It's like last time I looked, it was $95. Okay, so you had a stock that went from $4 to, in this case, $86. In addition, it had a 10% dividend yield, which, by the way, shortly after we bought it, they halved it. They cut it in half. But over time, that recovered. And if you look now, the annual dividend yield is 21% a year, just the dividend yield, because dividends have grown over that 12-year period. That's one of the things rich people do. They buy great companies when they're depressed for the dividend, and then over time, they've raised the dividend. The company keeps making more and more money, the dividend grows. And so a 5% dividend, a 10% dividend, like in this case, grows to be a 21% dividend every year. Okay, so it pays a 21% dividend yield, but then we're also trading calls against this position. And in this position, in September 21, the current dividend yield plus call premiums were 188% a year, 188%. And the average annual return over that 12-year period was 103%. How would you like to be in an investment that made 100% every year? That wasn't exactly every year. It went up and down, but had years that made 150, 200%, had years that made 20%, but on average, it's making 100% a year. That's just one of the names. And that was one of the best ones for sure, but it was just one of the 10. Well, look at that. You don't need many that are that good to do really, really well. And then this is a stock, it's 2024, 15 years later, you can still be holding it. Phenomenal. Okay. So on this investing versus trading, I want you to think about this. Many people who say they're investors are just traders. And if you are a buy and hold investor, which there's a lot of them out there, I have in one of our masterminds, we have a student who is a buy and hold trader. And I said to them, I said, it's when you're a buy and hold trader, which you really are as a trader, it's in a hope mode. You have no plan and you're just hoping it goes up and hoping it does not go down. Buy and hold is not a plan. It's not a strategy. Great traders have a plan and they execute that plan. So we want our money working for us. We want to have the velocity of money on our hand and our hand working in our favor. So we're examining all of our investments. We're examining all our trades and they need to be performing or we go find something else. All right. So I want to show you a really powerful schematic here and then we're going to move on. This schematic basically shows that if you can understand economic cycles, this gives you a roadmap of how to think about investing and trading and how to think about your investments in your overall portfolio. Okay, so when we're in a period of growth, you want to invest in things that appreciate because they can have a massive increase. How many stories do you know, whether it's crypto or it's stock prices like NVIDIA or it's business valuations, sports team valuations, whatever the case is. You go back and you look since 2011, even since COVID, they've exploded because we've been in a period of growth. Now, when we go into recession, like we did in 08, 09, or we did during COVID, the value of assets can fall really, really fast. So when we're in the growth stage, appreciation, the value of assets keeps going up and up. And as such, cash flow rate of returns go down. So there's a premise here it's really important to understand. Valuations can go up and down, but cash flow actually remains relatively constant. So if we go into a recession, I want you to think about how often do you see a landlord cut rent? You don't. It's very, very rare that a landlord reduces rent. If the economy's struggling, what do? Well, if you renew your lease or you sign with us, we'll give you 3 months free. We'll give you a signing bonus of 2 months or something like that. But notice what they're doing is they're not changing the headline rent. They're just adding bonuses. So rents in a recession tend to stay up. And then when we go through growth, rents often get raised, but they won't necessarily go up anywhere near the rate of appreciation. So in this formula, if we buy a condo for $300,000 and it pays $60,000 in rent, this is a 20% rate of return. Now I want you to look at it. If we go into recession and that condo goes down by half, goes down to $150,000, well, the rents are still $60,000. So if you could buy it at $150 instead of $300, your rate of return is now 40%. Your rents are the same, but the asset's cheaper. It's now a 40% rate of return. So if you can buy it at $150, now you have a 40% rate of return. And then if you hold it for several years, you can raise the rents. Then when you raise the rents, you can see your rate of return goes to 56%. So this model is the model of how you want to think about when you hit the gas and buy things for appreciation and when you switch and you think about buying for cash flow. You want to buy cash flow in recessions, buy appreciation and growth. I want to show you an example of a sample portfolio that was put on in March of 2020. Now, when you look at March of 2020, you might say, well, that's like an optimization. And I could see why you would say that. But actually, if you follow us and you follow my partner Mark called the bottom of the market on March 24th of 2024 in his service, clearly documented. And a series of techniques and indicators we use show that the market was getting deeply oversold in late March of 2020, which was a fantastic environment to begin putting names like these on. So this was a portfolio of 6 names: ExxonMobil, Chevron, Nucor, Walgreens, 3M, and Realty Income Corp. So these were all strong dividend names, and they were all considered to be dividend kings. In other words, these were stocks that they increased the dividend every year. And you can see it here. In the case of ExxonMobil, 37 years, Chevron, 33 years, Nucor, 47 years, Walgreens, 44 years, 3M, 62 years, and Realty Group, 25 years. These are called dividend aristocrats. So these are stocks that every dividend investor loves. All right. So when we look at this, and we're going to go through this quickly, but essentially what you can see is if you'd put $600,000 into this portfolio in 2020, you would have had a return of over $714,000 since then. You would have had an average annual return of 27% a year. And if you looked at your current dividend yield plus annual call premiums, it's 43% a year. So this portfolio, if the stocks go sideways, in theory, you'd make 43% a year. Now, in practice, it always ends up being a little less than this. We use it as a target, but it's still amazing. 43% in a year when the stocks go nowhere. So here's another example of a position that we've had on, which is in Newmont Mining. We put this on a couple years ago, and we put this on as a way, we're very bullish gold. We put this on as a way to be invested while we waited for the gold theme to take off. So we've been invested in this since October 21st of 2022. We got long at $42.34. And essentially this Newmont has returned essentially 14% a year since 2022. And we are long one of the top gold miners in the world for when gold really does take off, and it's starting to, and the gold miners really take off and they're starting to. This could be a phenomenal investment. So we use the WAM Dividend Accelerator in several different ways. For you, if you have a stock that you maybe bought very early on or was gifted to you in inheritance, or you had stock options where you worked at a big company and you got granted stock at a low basis, this strategy is amazing. And this is something I've had several students that I started working with them, and we pulled out a stock like this, and they started making $100,000, $200,000, $400,000 a year just off of stocks they already had that were just sitting there. How would you like to find something? How would you like to find 150 grand a year that you didn't even know was there, that you had to do virtually hardly anything, right? And 1 to 2 hours a week. And in this case, with one name, it's simple. It's not even an hour a week. It's like 10 minutes a week. And you can pick up 150, 200 grand a year. So if you have a low basis in a stock and you are interested in this, I highly recommend, 1, you look at the course, but 2, you can just reach out to me and we can help talk you through it. So here we go. The 9 reasons. I told you I would give you number 7. What's number 7? Check this out. We're looking at these investments that can produce 20% a year or greater for years to come. What if I told you could have an infinite return? What if I told you you could have an infinite return? Well, how would that work? You'd put the money in the strategy. You'd have these returns of 20, 25, 40, 50%. But then at a certain point, what we would do is we would utilize a specific option strategy, and we'd take all your money out. We'd take all the money that you used to buy the stock. We'd remove it all. So all you would have is cash flow. You'd have dividends and option premiums coming in, but no money up. So instead of making 25% a year, you make infinite. You take that original money and you go invest it somewhere else. It's totally possible, totally doable. We show you how to do it. So what day is it? Yeah, it's Tuesday. It's not just any Tuesday, it's Trader Tip Tuesday. And that's why you're tuning in for Trader Tip Tuesday, where every Tuesday I come to you with techniques like the WAM Dividend Accelerator that help you take your trading, help you take your investing, and help take your life to an elite level. I'll see you next Tuesday. Oh, I almost forgot. We have a special gift for you. I want to give you the 8 irrefutable laws of investing success. A lot of these principles that we talked about today in Trader Tip Tuesday are in the 8 irrefutable laws. If you look at the comments below, you'll see a link. You can click on that link to get your version of the 8 irrefutable laws. Use these laws whenever you think about investing, and it will totally raise your game. Thanks again for watching.